They call it capitalism. But you know it's a war.
They built it up to $47 billion. The fall was inevitable. An empire built on an illusion. And this is how it happened.
Today, we dissect one of Silicon Valley's most shocking financial bubbles.
Jaded. While Yahoo was a tech decline, WeWork exemplifies behavioral economics and corporate cultism.
To grasp this corporate deception, we must begin with basic financial valuation. Founded in 2010 by two entrepreneurs in New York. At its core, WeWork was a commercial real estate subleasing company. Leasing long-term wholesale, then subleasing short-term retail for profit. Traditionally, companies like IWG are valued with low revenue multiples due to thin profit margins and extreme risk during market freezes. A charismatic entrepreneur, a master of crowd psychology, saw this limitation. He knew major financial institutions wouldn't fund a mere real estate company. So, Neumann launched his tech masking strategy.
He proclaimed his venture wasn't selling offices, but a physical social network.
And an ecosystem for future creation, or space as a service. This wasn't just about the balance sheet. It was predatory lending disguised as structured finance. We knew the default risk was exponential. Come closer. The real money isn't made in the light. It's traded in the dark. Forcing them to value WeWork like a tech SaaS company, 20x to 40x revenue. WeWork's valuation soared to an unthinkable $47 billion. How did a charismatic entrepreneur persuasively influence even a prominent investor? A prominent investor, one of the planet's most powerful financial figures. The entrepreneur sold a grand vision, not financial metrics. Our mission is to elevate the world's consciousness. In behavioral economics, the entrepreneur expertly triggered a sense of urgency in the prominent investor. In 2017, a 28-minute car meeting in New York sealed the deal. The investor looked at the entrepreneur and uttered an iconic phrase. Greed, for lack of a better word, is good. In a challenging situation, the bold one often prevails. But you are not bold enough. Immediately, SoftBank injected $4.4 billion into WeWork. With a major investment firm's funds, the entrepreneur transformed a co-working space company into a company with a strong, devoted community culture. Alcohol flowed freely. All-night parties became common. Mandatory company retreats had the entrepreneur speaking with inspiring conviction. The ambition reached its height with the entrepreneur's confident pronouncements. WeWork would solve global hunger, he confidently declared. He would become president of the world. Or the first human trillionaire. August 2019, the $47 billion illusion shattered with the S-1 filing. Mandatory for IPO, major financial institutions' cold math contrasted sharply with the entrepreneur's persuasive rhetoric. Leading economic analysts were surprised by the prospectus's contents. WeWork was an infinite money-burning machine.
In 2018, 1.8 billion revenue against 1.9 billion net loss.
Earning $1 meant burning $2. It was the ghost haunting the balance sheet. $47 billion looming over the very foundation of the company. While client revenue was secured only monthly, a dangerous asset-liability mismatch. The same prospectus exposed the entrepreneur's transactions involving personal interests. He acquired properties, then arranged for the company to lease them from him under favorable terms. Even worse, the entrepreneur trademarked "we," then transferred the rights to the co-working space company for a significant sum.
Wall Street erupted in fury, and this wasn't a tech startup.
This was a sophisticated pump and dump scheme, expertly disguised. Within 33 days of the S-1 filing, valuation plummeted. From $47 billion to under $10 billion. The highly anticipated IPO was completely canceled. September 2019. To avert immediate financial crisis, the board requested the entrepreneur's resignation. However, the injustice of top-tier payouts enraged the public again. SoftBank signed a golden parachute power swap deal worth $1.7 billion. Thousands of WeWork employees were laid off with no severance. Their vested stock options became utterly worthless paper. The architect of significant financial challenges, however, departed as a cash billionaire. After years of struggle and the COVID-19 pandemic's fatal blow to office work. In November 2023, WeWork officially filed for Chapter 11 bankruptcy in the U.S.
The $47 billion empire was now a financial ruin, leaving Silicon Valley with its bitterest lesson.
Now, let's dissect the 3 fundamental lessons from this saga. Lesson 1. Asset nature dictates valuation, not marketing language. This was the old way, capital-intensive, heavy machinery, and endless overhead. But the future is lean, asset-light, digitized, and silent. Investors must examine marginal cost structure, not just flashy founder stories. Lesson 2. The collapse of corporate governance. The company's rules gave a key executive's shares 20 times normal voting power. This granted him significant control, influencing the board's decisions. Founders' egos and power must never override independent shareholder control mechanisms. Lesson 3. FOMO is the enemy of rational financial thought. The prominent investor made decisions based on intuition, not solely discounted cash flow analysis. Investing on a founder's charisma instead of fundamentals is gambling. The WeWork story is a stark reminder of delusion's profound cost. Always scrutinize the numbers, not just the narrative.
A crucial lesson for every investor and entrepreneur alike.
Thank you for watching Magnate's Ledger. What insights did you uncover? Share your thoughts below. Subscribe for more exclusive business secrets. Join us for deeper insights. Until then, stay curious.